Hello everyone, this is Roger Scott from Market Geeks with another video tutorial for you today. Before I begin, I'd like to remind you to subscribe to our video channel and don't forget to visit marketgeeks.com for your free trading report. Today I'm going to show you how to incorporate simple channel breakout trading strategies into your trading plan. Oftentimes, traders transition from short-term trading to day trading using simple methods such as channel breakouts. I encourage beginners to start off with simple methods and only delve into complex methods when they are consistently profitable. The channel breakout is one of those basic strategies that beginners seem to gravitate towards when they first start out experimenting with different trading methods. This tutorial is going to show you some basic filters so that you can learn how to trade intraday breakouts while decreasing your percentage of false breakouts that occur so frequently. Make sure you follow each step along the way and always make sure you're trading in the direction of the main trend regardless of the time frame you choose to trade. Also note that this method applies to stocks, futures, commodities, and currency contracts. The first thing on your list should be a trending market. The biggest reason for false breakouts is taking signals against the main trend. By following the main trend, you will increase your profit ratio and increase your percentage of winners to losers. So the first step is to find stocks or other markets that have been trending strongly for at least a few weeks. In this example, you can clearly see the stock trending strongly down after a classic reversal double top pattern developed. Once you identify the stocks or other markets, you need to begin monitoring short-term support and resistance levels for strong gaps in the direction of the trend. The best gaps occur at the opening bell with strong momentum and volatility. Once your setup is triggered, you place a market order to enter the trade. Make sure the gap is accompanied by strong volume and momentum is pushing only in one direction. You can usually tell by looking at the opening and seeing how far against the opening price the stock is going. In this particular case, the stock moved almost continuously down after the opening bell. There's very little volume buying this stock at this point. Once you enter the position, you need to place a stop loss or a buy stop in this case because you're selling short. The stop is placed halfway between your entry point and the previous closing price. For example, if the difference between the previous closing price and the opening price this morning is $3, you would add $1.50 to your entry price, and that would be your stop loss or buy stop order in this case. Profit targets for this method are MOC or market on close. This means that your position will be liquidated within a minute or two of the closing bell. This is called the closing range, and during this time, resting orders are filled. Let me show you an example to the long side so you can see how the trade sets up from both sides. I start out finding a stock that's been trending strongly in one direction. The better the trend, the higher the odds that the breakout will be going in the right direction. Don't try to pick market tops and bottoms when you're first starting out. Once you identify a strong trend, you should monitor the daily support and resistance levels. If the trend is up, you only need to pay attention to the resistance level. And if the trend is down, you need to pay attention to the support level. These are critical breakout levels, so you should know exactly where they are located. Don't be afraid to enter the position that's moving quickly. Oftentimes, I see traders freeze up when markets are opening and positions are moving quickly. You need to be prepared to execute and know exactly what you're going to do after the opening bell. Plan ahead and keep a detailed notebook with your support and resistance levels. In this example, the move is fast and carries strong momentum in one direction. You should also look at the market from a daily chart and intraday chart so that you can monitor the trading action closely while you're positioned in the market. Once the position is filled, your stop loss is placed halfway between your entry and the previous day's closing price. The great majority of the time, your trade will not go back to that level if it's working out. This provides you with a reasonable degree of protection in worst-case scenarios. Don't forget to maintain the position till the closing bell to gain maximum opportunity for movement in your direction. That's it for today's tutorial. I hope you enjoyed this short tutorial about breakout trading strategies. Don't forget to subscribe to our video channel, and please visit MarketGeeks.com for your free trading report. This is Roger Scott wishing you the best in your trading.